Hi there, my name is David Schlossberg with Assured Concepts Group and today's episode of the Rest Assured podcast. Today's topic comes from a beneficiary's perspective. Why is it better to inherit Roth assets than traditional IRA assets? First and foremost, we need to understand the difference between traditional IRA assets and your Roth IRA assets. With traditional IRA assets, when you made the deposit into the traditional IRA account, you made a deal, a handshake deal with the Internal Revenue Service. That deal said that on the amount that you put in, you're going to get a tax deduction or not pay taxes on the wage for the amount of money that goes into your 401k and later becomes a traditional IRA, or for your traditional IRA contribution on your tax return. So you got a tax deduction up front with the idea that at some point in time, you would take distributions from that account and you would pay the tax then. Now, you're not only going to pay the tax on the amount of the original contribution you made, but you're going to pay the tax on all the gain that was made as well. And this tax is going to be assessed based on the amount of distribution that you take each and every year. The IRS won't allow you to last forever and never take these distributions. Current regulations that were passed in December of 22 now has a required distribution starting at the age of 73. So you can accumulate those monies and all that growth on a tax-free basis. But once you turn age 73, you have to start making those distributions and paying the tax on that money the piper wants to get paid. On the Roth IRA, you're not making a tax deduction at the time that you make the contribution, but you also have a deal with the IRS who wants to encourage you to save for retirement. And that deal that was made was you don't get the tax deduction when you make the deposit, but none of the earnings will ever get taxed as long as you follow a few simple rules. One of them is a 5-year holding period. So as long as you've had your Roth IRA for 5 years or more, then you qualify in order to have tax-free distributions of not just your deposit, which you already pay taxes on, but also on all the earnings that were accumulated. A lot of workers, when they get later in life, realize that they'd rather have some of their monies or all of their monies not in the traditional IRA, but rather in the Roth IRA. And so they can do conversions. They can move from the traditional IRA to the Roth IRA, and they can pay off that tax bill when they do the conversion, so that future growth of those converted dollars will never be taxed. So you can effectively say, I want to mulligan on the original deposit that I got a tax deduction on. I'm willing to pay the tax on it now. I'm willing to pay the tax on the earnings that I move over to a Roth, but now I get to enjoy those Roth benefits of all the future growth not being taxable at all. And additionally, there is no required minimum distribution for you on the Roth. There would be for your heirs when they inherit it, and we'll talk about that in a bit, but there's no required minimum distributions on the Roth to mess up your personal tax return. So let's talk about the tax implications to a beneficiary of inheriting a traditional IRA account, and then I'll also bring up the tax implications of the Roth account. We need a little background on this to understand it. The rules changed in December of 2019 when Secure Act was passed, now known as the Secure Act 1.0. It was passed in December of 2019, and it effectively said that if you're a non-spousal beneficiary of an IRA, then you have to empty that IRA account within 10 years after the person passes away, or at the end of the 10th year after the person passes away. So if you inherit money, a traditional IRA in 2023, you can leave the account sit until 2033, and then by December 31st of 2033, you have to empty that IRA account. That was the rules as passed in December of 2019, and there's been some changes since then. But let's first evaluate that rule. Let's just say you inherited $1 million, you don't need the money, you're doing okay, and you let it sit for 10 years. At a 7% earnings rate, that $1 million would become $2 million. What do you suppose your tax return is going to look like when you have to empty an IRA that has $2 million in it? It's not going to be pretty. Not at all. By choice, you could elect to take some out each year as you go, but by doing so, you wind up losing the benefit of the tax deferral. So you don't necessarily wind up ahead at the end of the game, except your individual, your tax return surely would look a lot better in 2033, but for every year between now and then, it's not going to look better. Let's also just say that you have these annual distributions and you now have a child that comes up to college age. You're going to lose the child tax credit probably. You're going to FAFSA form is going to look a lot worse because all this IRA distributions are going to wind up on your tax return. That tends to be a problem for beneficiaries. Let's talk about how the rule changed in December of actually in February of 2022. The IRS passed a regulation and said, effectively, the way that the Senate wrote the rules in the Secure Act 1.0 is not good enough for us, and we want to pass a regulation to take advantage of the ambiguity in the tax bill. And the regulation that they passed basically stated this. It says that if you inherit a traditional IRA and the person that passed away was subject to required minimum distributions and you're a non-spousal beneficiary, then you have to take required minimum distributions for the first 9 years of that account and then empty the remainder at the end of the 10 years. So it effectively changed it from being able to defer any distributions to the end of the 10th year and now requires, based on your age, to take some distributions every year for years 1 through 9 and then empty the rest at the end of the 10th year. Taking that same scenario that you have students that are now becoming of age for college, that can certainly have negative tax implications on your tax return. And it can certainly also influence scholarships or student loans because of all this income that's on your tax return, in addition to your ordinary income that you can be making. It could put you into phase out of certain deductions. It could cause you to have a 3.8% net investment tax added onto your tax return. There's a lot of potential implications when you start adding these distributions onto your tax return every year for those 9 years. And then certainly when you have to empty the remaining bucket at the end of the 10th year, there could be some severe tax implications. Given the question, would I rather inherit $700,000 of Roth assets or $100,000 of IRA assets? I would say $700,000 of Roth assets for this reason. Number one, if I wanted to take distributions over those 10 years, I could do so. And it's not going to have any tax implications whatsoever because that $70,000 a year or whatever amount I take is going to come to me without any taxation. It's not going to show up on my tax return as a taxable event or item. It's not going to impact my FAFSA forms. It's not going to impact my eligibility for scholarships or for school loans and whatnot. And it's not going to force me into net investment tax being added onto my tax return. So I can inherit the Roth assets and not have all the tax loopholes attached to it. Additionally, I don't have to pay any tax on the $700,000 whenever it comes out, and I can allow it to grow for 10 years, regardless of the decedent's age, because there are no required minimum distributions on Roth accounts. So if I inherit $700,000, I have the freedom to allow it to grow for 10 years. And at the end of the 10 years, I have to empty the bucket, but at a 7% rate of return, that $700,000 would become $1.4 million, which could all come to me free of taxation at all. Additionally, I can create a trust account to try to isolate and provide some sort of creditor or marital protection for that inheritance. And I can dump the Roth into the trust account without worrying about the high tax rates that trusts are subject to. So I've got additional asset protection available to me when I'm inheriting a Roth asset that isn't as freely available when inheriting a traditional IRA. Beneficiaries that receive traditional IRAs that are non-eligible designated beneficiaries, predominantly anybody that's a non-spouse for the most part, or who's not disabled. Anybody that inherits those funds will be subject to required minimum distributions for 9 years, for the first 9 years, if the person that passed away was subject to required minimum distributions. So anybody beyond the age of 73 would be in that category. So if your parent passes away and they're beyond the age of 73, when they pass away, you're going to have required distributions of your inherited IRA for the first 9 years, and then you're going to have to empty the rest of it at the end of the 10th year. So Roth IRAs do not have required minimum distributions for either the account holder nor the beneficiary. So you'll never have to distribute it, to make distributions as the account holder. And if you're the non-eligible designated beneficiary, which for the most part is any living person that is not the spouse and not a disabled person, then you don't have required minimum distributions, with the exception of having to empty the account by December 31st of the 10th year following the decedent's death. So, answering the question as to when it would be advantageous to inherit traditional IRA assets instead of Roth assets, I can't think of very many situations where that's the case. One situation where that might be the case is when the inheriting beneficiary is very philanthropically minded and is going to give the majority of those IRA assets to a charity. That would be one circumstance that it would be advantageous to receive traditional IRA assets. Other than that, I can't think of too many advantages, to be honest. In order to convert from a traditional IRA to a Roth IRA, you simply have to make an election to move the monies from account A to account B. So if you have an established IRA, you open an established Roth IRA if you don't have one, and you literally move the funds directly from the traditional IRA into the Roth IRA. You can move the assets, i.e., mutual fund shares or stock shares, exactly as they sit, and the value on the date that it moves would be the taxable event. You then would pay the tax on the amount that you move from your traditional IRA to your Roth IRA with your taxes that particular year that you do the conversion. There is no income limitation in order to do a conversion, so anybody can do it. You don't have to have earned income when you do the conversion. You don't have to be a certain age in order to do the conversion. So there's very little restrictions or limitations on the conversion. The only restriction that really is in place is that if you're beyond your required beginning date and you have to take required minimum distributions off your traditional IRA, then you must take 100% of the distribution that's required in the calendar year before you do your conversion. So, for example, if you had a $30,000 annual required minimum distribution and you were taking $2,500 per month in order to satisfy that RMD, you'd have to wait until the last monthly distribution occurs before you can do your conversion in December. Generally, in most years, we think the market is going to increase and not decrease. Most years. And so, therefore, it's advantageous to do the conversion at the beginning of the year so that that year's growth is in the Roth account and not subject to tax, instead of waiting till the end of the year when the traditional IRA has a larger value. And then you have to convert more, you have to leave some behind in this account that's later going to be taxed. So, generally speaking, we recommend the conversions early in the year. If you're used to a monthly distribution and you have a required minimum distribution, the rules change a little bit, and that you need to take the annual amount of distribution at the beginning of the year in order to then do the conversion at the beginning of the year. But that's the only restriction on who can do a conversion and when you can do the conversion. So, once more, the changes in the tax law that occurred in December of 2019 went from a non-spousal beneficiary's ability to stretch distributions during their expected lifetime, which often was 40 plus years, and required them to empty the account in the 10th year. Roughly 27 months later, the IRS added additional regulations that stated that if If the decedent was beyond the required beginning date and was subject to required minimum distributions, then the beneficiary needed to take required minimum distributions for years 1 through 9 in order to satisfy the rules that were passed. So if the decedent wasn't subject to required minimum distributions, you can retain the whole account for 10 years before you're required to empty it. And if the decedent was past the required beginning date, then you'd have to take distributions every calendar year for years 1 through 9 and then empty the rest of the account in year 10. So, talking about inheritors and those the beneficiaries of these assets, I often think in terms of asset protection concerns. Because nobody wants to leave a great amount of assets, certainly not 7 figures behind for their heirs, for their children, only to wind up to have half of that money go to, say, for example, the ex spouse to be, right? Everybody wants their child to have 100% access to the funds without having to share it with a spouse that they might have challenges with. So, some of the tips for the beneficiaries, actually for the parents that are set to leave these beneficiaries some money, is to get some good legal advice on the proper structure on how to leave IRA assets behind to the next generation in a manner that keeps asset protection in mind. And so, traditional IRA assets versus Roth IRA assets, there's a significant difference in the way that you would structure your trust or other documentation in order to do that. And so, my advice or my tip is to seek good counsel that's aware of these matters, either a financial advisor that has a really good estate planning background and understands the implications, or an estate planning attorney that understands the implications of inheriting IRA assets. So, in regards to recommended resources, I'm not sure that I would send people to the internet to do a Google search like I would on a lot of other topics. The reason being is, of course, we know that a great deal of what we find on the internet might be accurate, but also there's a great deal that could be misleading or not provide the complete complexity of guidance that one should be aware of. So, in regards to this particular topic, if you're going to be leaving a fair amount of IRA assets behind to the next generation, or if you're going to be a beneficiary and you know that you're going to be a beneficiary of a great amount of retirement type of assets, I'll strongly encourage you seek an estate planning attorney that's very versed in the IRA complexities. So, an attorney that works exclusively in the estate planning arena, not a general practitioner, or to seek a financial advisor that takes a holistic approach and knows very well about the implications to inheriting an inheriting person of these IRA assets. So, I strongly suggest human guidance and human counsel in this matter versus a Google search because of the disinformation that could wind up causing a lot of problems later on. I think that this should summarize for beneficiaries as well as those people that were leaving IRA assets behind why a Roth IRA is a better asset to leave behind to the next generation. Now, whether or not you're prepared to pay taxes to do conversions, that's a bigger conversation. But certainly for assets that you're leaving behind, I know that if I'm a beneficiary, my choice is certainly to receive Roth assets, even if it's only 65 or 75% of the original IRA value. My choice would be to receive those Roth assets over IRA assets to not have the complexity show up on my tax return. But I do encourage you to seek counsel. We'd be glad to entertain any questions you might have on the topic. So that summarizes the topic on inheriting Roth assets versus inheriting traditional IRA assets. Thank you for joining our Rest Assured podcast today. My name is David Schlossberg with Assured Concepts Group. I'll invite you and encourage you to do two things. Number one, continue to listen to upcoming podcasts on a variety of matters that we can provide some advice and counsel on. We're very glad to pass this information along to you. And additionally, if you'd like a personal consultation on this topic, we'd be very happy to have a conversation with you. Please give us a call at our office and arrange a short introductory phone call for the purpose of discussing these topics. Thank you again for listening.